QE transformed the financial landscape for everyday savers. There's an even darker transformation happening to stock markets themselves. Did you know when you click buy on your fancy brokerage app, that trade probably isn't happening where you think it is? That iconic NYSE trading floor you see on TV with all the screens and shouting? Mostly just theater these days. The real action happens in secretive private venues with the decidedly creepy name of dark pools. Where up to 40% of all U.S. stock trading now takes place completely hidden from public view. Let's be real for a second. When you picture the stock market, you're probably imagining a transparent system where buyers and sellers meet to trade fairly. But the modern reality is far more complicated and honestly kind of sketchy. Think of dark pools as exclusive underground clubs where VIPs make deals behind velvet ropes, while the rest of us are left in the regular, brightly lit venue where everyone can see our moves. These dark pools are private trading venues operated by major banks and financial institutions where massive investors can trade huge blocks of stocks in secret. Here's a concrete example. When a major hedge fund wants to unload 10 million shares of Tesla, they don't want to show their hand. If they placed that order on the public NYSE, everyone would see it, and the price would immediately tank before they could finish selling. Instead, they quietly execute the trade in a dark pool. The public sees nothing until after the transaction is complete, by which time the big players have already made their moves, potentially leaving regular investors holding the bag. Why should this matter to you? Imagine playing poker where the richest players at the table keep their cards hidden until after you've placed your bets. That's essentially what's happening to your retirement savings. While you trade based on publicly available information, the big players make moves in secret, seeing order flows and price data you'll never access. The shift towards secrecy is dramatic. In 2009, dark pools handled about 16% of U.S. stock trades. Today, it's hovering around 40 to 50%. Almost half of all trading happens in secretive venues most retail investors can't even access. But dark pools are just the beginning of this shadow market. High-frequency trading firms have created another layer of unfairness. Think of these traders as having superhuman reflexes in a marketplace where speed determines who wins. These companies have positioned specialized computers right next to exchange servers, giving them a speed advantage measured in microseconds. In the algorithmic trading world, a microsecond advantage is like having a time machine. These high-frequency traders use their speed advantage to engage in what's called front-running. It's like someone seeing you heading to the store to buy the last gallon of milk, then racing ahead to buy it first, only to sell it to you at a markup when you arrive. When you decide to buy Apple shares at $180, your order information might be sold to a high-frequency trading firm. They see your order coming, quickly buy Apple shares at $180, and then sell them to you for $180.05. 5 cents multiplied by millions of trades daily equals billions in profits skimmed from regular investors. The lengths these firms go to for speed advantages are astounding. Michael Lewis's book Flash Boys exposed how they build special fiber optic cables in straight lines between financial centers, drilling through mountains, just to gain millisecond advantages. One firm spent $300 million on a cable from Chicago to New Jersey that made their trades 3 milliseconds faster. Literally faster than you can blink. And the investment paid for itself in less than a year. This Wall Street shoddiness directly impacts your investments. When markets aren't transparent, price discovery gets distorted. The 2010 flash crash showed the dangers when the Dow dropped nearly 1,000 points in minutes before rebounding. Your 401k could have lost 10% of its value in literal minutes because of computers trading with other computers in dark venues. Dark pools are also less regulated by design. In 2016, Barclays and Credit Suisse paid $154 million in fines for misleading investors about how their dark pools operated. They promised protection from predatory traders while actually giving those same traders special access. Regular investors paid worse prices while thinking they were being protected. The SEC consistently plays catch-up. By the time they identify one sketchy practice, Wall Street has invented 3 new ones. It's financial whack-a-mole with your retirement savings on the line. Fragmented trading across dozens of dark venues makes maintaining liquidity during market stress harder. When things get scary, these shadow markets might actually make a crash worse. Your own retirement fund manager might be using dark pools too. justifying it by getting slightly better prices by hiding their trades. So your 401k might benefit in small ways from the same system that's potentially undermining market fairness overall. Defenders claim these practices make markets more efficient and provide liquidity. But if that were true, why would Wall Street fight so hard against reforms that would increase transparency? Opacity benefits insiders. Transparency would benefit everyone else. For regular investors, this shadow market means accepting you're playing a game where the rules favor the house. It doesn't mean you shouldn't invest. The stock market remains one of the best ways to build wealth over time, but it does mean understanding that the system has built-in disadvantages working against you. Wall Street